Okay, so you've likely felt it too, that bit of a wobble in the stock market lately.
Oh, yeah, definitely.
We saw some pretty sharp drops. Then, well, a little bit of relief maybe, when the Trump administration announced that temporary pause on tariffs.
Right, for most countries,
Mm.
but not China. That was the exception. The Motley Fool covered this just yesterday, April 12th.
Exactly. But, that lift didn't really last, did it? The market's kind of dipped again since then.
It's definitely a nervous time for investors. I mean, it's understandable, right? When things swing because of global stuff like tariffs, figuring out the next move feels, well, tricky.
That's precisely why we wanted to do this deep dive. You shared that Motley Fool article, and asked a really interesting question, I thought.
Which was,
Basically, if this whole tariff situation keeps pushing the market down, where could investors, maybe find some potential opportunities?
right, looking for value when things look shaky.
Yeah. And the article zooms in on a couple of big names. So we thought, let's really unpack why the article thinks they might be worth a look if the market stays choppy.
Okay. And just to be clear, this isn't like specific stock advice from us.
No, absolutely not.
We're just trying to understand the thinking, the strategies the article lays out. Hopefully it gives everyone listening a clearer way to think about these kinds of market moves.
Okay, let's dig in then. First up, the article talks about American Express. Ticker is AXP.
An Amex. Right.
And the core idea seems to be their focus on affluent spenders. That's the term the article uses. The thinking is that this might make them surprisingly kind of resilient right now.
Yeah, they call it a mainstay brand, and that focus on higher income customers is, well, it's fundamental to how Amex works.
How so?
Well, they've really built this customer base, often through those premium cards, the ones with the perks and the fees. These customers tend to be maybe less hit by economic bumps compared to the average person. It gives them a degree of stability.
And it's not just about the annual card fees, though, is it? The article said something about swipe fees.
Exactly. That's actually a huge part. Over half their revenue comes from the fees merchants pay every time you use an Amex card.
Because they run their own payment network.
Precisely. Unlike, say, Visa or MasterCard, who mainly just provide the network for banks, Amex does both, issues the card and processes the payment.
So they control more of the process.
Yeah, it gets them more fees, maybe makes them a bit more flexible. It's a key difference.
Okay, this next bit surprised me a little. Their success with younger people. Gen Z and millennials.
Yeah, the numbers are pretty big. What was it? 12.2 million new cardholders from those groups in 2023.
And another 13 million in 2024. That feels like a massive influx.
It is. And it's not just the number, it's how they spend. The article mentioned the average spend per card member was nearly, $25,000 last year?
Wow, so they're not just getting the card, they're actually using it a lot.
Right, they're engaging with the whole Amex system.
And thinking long term, I guess. As these younger folks advance in their careers, make more money.
Their spending power is likely to just keep growing. They could be incredibly valuable customers for Amex for decades.
Makes sense. So even if things are uncertain now, they're kind of building for the future by getting these customers locked in early.
That's the strategic play, yeah. Attract these valuable younger groups now.
Okay, but the article does talk about the R word. Recession. Potential for one in 2025.
Right. And obviously, if people lose jobs, cut back spending, that hits companies lending money, like Amex.
So their earnings could take a hit.
Could, yeah, especially on the loan side of things. But here's the article's counterpoint. Because Amex focuses on that more affluent group.
They might be better shielded.
That's the idea. Wealthier people often have more savings. Maybe their spending doesn't change as drastically. The article points to the 2022 inflation scare.
What happened then?
Their loan default rates apparently didn't jump as much as maybe you'd expect for a typical lender. It showed some resilience in that customer base.
Interesting. So they've kind of built in a buffer through who their customers are.
Sort of, yeah. And beyond just weathering storms, the article also mentioned Amex has a history of raising its dividend, buying back its own stock.
Which investors usually like to see, right?
Generally, yes. Dividends mean direct cash returns. Buybacks can help boost earnings per share over time. Signals a focus on shareholder value.
And management seems pretty bullish. The article mentions their targets, 10% annual revenue growth and earnings per share growing even faster.
Those are strong targets for a big, established company. Shows confidence, definitely. Doesn't sound like they're planning for a major slowdown.
So pulling it all together for Amex, the article seems to suggest that if this tariff stuff keeps hitting the market and Amex stock gets cheaper,
It could be a compelling long-term opportunity, a rock-solid bet, I think was the phrase used.
Yeah, though we should mention the article notes Amex is an advertising partner of Motley Fool Money.
Right? Important disclosure, good transparency.
Mhm.
But the core analysis about the business model, the customer base, the growth potential, that still stands based on what's presented.
And just for context, checking the numbers from April 11th, Amex market cap was around $176 billion. Stock was down about 1.85% that day, trading just over $251.
Okay. So yeah, feeling some of that market pressure already at that point.
Right. Okay, let's switch gears. Second company, Visa, ticker V.
Ah, Visa. Another giant, but yeah, different model.
How different? The article flags this as key.
Well, where Amex issues cards and runs the network, Visa is pretty much just the network.
So they don't issue the cards themselves?
Nope. Your bank issues your Visa card. Visa just provides that massive global system that lets the transaction happen between your bank and the merchant's bank.
And that focus seems to have paid off in scale. The number the article gave was staggering.
Yeah, 4.7 billion Visa debit and credit cards out there globally at the end of their last fiscal year.
Billion. It's almost hard to picture.
It really is. And that scale creates this, powerful network effect. Every time one of those billions of cards gets used, Visa takes a tiny slice. It's incredibly efficient.
But similar issue to Amex, right? If there's a downturn, people spend less.
Fewer transactions, less total money flowing through the network. Yeah, that would impact Visa too, absolutely.
Okay, but the article also talks about these big long-term tailwinds for Visa. Things like inflation.
Yeah, inflation, just general global economic growth, and maybe the biggest one, the massive shift away from physical cash towards digital payments, cards, online, mobile.
And those trends aren't going away anytime soon. Seems pretty locked in.
They really do. As economies grow, as prices rise with inflation, the total value going through Visa's network tends to go up. And that move to digital, Visa is perfectly positioned for that.
The recent numbers look pretty good, too. Article mentioned, 9% growth in total payment volume?
Year over year, yeah, in constant currency.
Yeah.
And net revenue was up 10%.
And apparently not just from transaction fees. Something about analytics and pricing power.
Right. They're adding services on top, providing data insights, and because their network is so dominant, they have some power to set their prices. It shows the strength of their position.
And the profitability.
Wow.
A phenomenal 66% operating margin.
Yeah, that's incredibly high. Very efficient business.
Plus, earnings per share growth over the last decade was 317%.
Astonishing, really. For a company that size to grow earnings that much over 10 years is quite something.
And the article even hints that the next decade could see similar, maybe even better growth, especially if inflation stays high.
Well, the logic is simple. Visa takes a percentage cut. If the price of everything goes up, the value of each transaction goes up, and so does Visa's cut in dollar terms.
Okay, so Visa sounds incredibly strong. Dominant network, profitable, riding these huge trends. But there's a catch, according to the article.
The valuation.
Exactly. Trading at an expensive trailing price-to-earnings ratio, PE, of 33.5. What does that mean in simple terms?
It basically means the market already expects a lot of future growth from Visa, and that expectation is baked into the current stock price. You're paying a premium compared to its past earnings, more so than for many other stocks.
Well, it might not be the best time to jump in right now, even though it's a great company.
That's the suggestion. The recommendation wasn't buy now, but more like keep it high on your watch list.
Watch list, okay. Be ready to potentially buy if a market downturn makes the price more attractive.
Precisely. And again, the article notes, the Motley Fool has positions in and recommends Visa.
Right, another disclosure, important to know.
But the point about valuation stands. Even for a fantastic company, paying too high a price can hurt your returns. So maybe wait for a better entry point if the market gives you one.
Got it. And Visa's price on April 11th was around $333.56, down about 2.76% that day.
Okay, so yeah, also feeling the pressure like Amex.
All right, so let's try and synthesize this. What's the main takeaway from the article about investing when the market's shaky because of things like tariffs?
I think the core message is pretty clear. Don't panic. Downturns, even scary ones driven by tariffs or whatever, can actually be opportunities.
Opportunities to buy good companies cheaper.
Exactly. If you have a long-term view, you can potentially pick up shares in really solid businesses at better prices than you could when the market was flying high. Look past the short-term noise.
And the article gives us two slightly different plays here based on these two companies. For Amex,
The suggestion is maybe it's already potentially attractive or could become very attractive if the price dips further, given its resilient customer base and growth plans. The valuation seemed perhaps a bit more reasonable at the time compared to Visa.
Right. But for Visa.
It's more of a patience game. Fantastic company, huge long-term potential, but maybe the price is still a bit steep right now.
So recognize the quality, but wait for a potentially better buying opportunity if the market weakness continues.
That's the idea. It's a bit more nuanced, acknowledging the quality, but also being price conscious. You don't want to overpay, even for the best.
And for both companies, despite any potential recession bumps in the short term.
The article really emphasizes that the long-term growth stories seem intact. Strong fundamentals, competitive advantages, riding big trends.
That seems key for anyone investing for, years down the line, not just the next few months.
Absolutely. Short-term volatility doesn't necessarily derail the long-term potential of great businesses.
Okay. So, wrapping up this deep dive into the Motley Fool's take, we've looked at American Express as maybe a potential buy on a dip, and Visa as a top-tier company to keep a close eye on for a better entry price, all in the context of this tariff-fueled market uncertainty.
Two different models, different current valuations, but both seen as having strong long-term prospects according to the source. And again, this was based on info up to April 12th, 2025. Things change fast.
Always do. Okay, so here's a final thought for everyone listening. Thinking about Amex and Visa, they're different ways of doing business, their current stock prices. What factors would be most important for you personally? What would you weigh most heavily if you were deciding whether to invest in either one during a market dip? Is it the customer base? The network scale? The current price tag? Something else?
Yeah, think about your own goals, your own tolerance for risk, your time frame.
Definitely something to mull over.